The time value of money, TMV, is one of the fundamental financial concepts that revolves around the changing value of money over time. It reflects the belief that money today is worth more than the same amount received at a later date. Mastering time value of money concepts will help you understand how a series of cash flows are calculated and what they mean for future investment decisions. Additionally, it can strengthen your ability to solve other finance and commercial real estate problems. Present value. When it comes to financial calculations, present value is one of the most important terms that you can use. It is the value of an amount of money received in a specific future time, which has been discounted to its value today, based on an implied rate of inflation or the rate at which it could have earned if invested. The term present value is commonly used in finance to compare the values of different financial offers and determine whether they make sense or not. For example, if a business offers a cash rebate or 0% financing on the purchase of a car, the present value of these benefits will help you decide whether to take the offer or not. It also helps you determine if it is worth paying points on your mortgage to save on interest payments later. If the present value of these savings is greater than the payment points you pay now, then it makes sense to take the offer and save on interest payments in the future. Inflation is a major factor in present value calculations because it can reduce the purchasing power of money over time. For example, if an economy experiences a 10% increase in prices, then your $1,000 today would only buy you $900 of goods and services next year. Present value is also a key concept when you are considering buying a home, and it can help you figure out whether to pay 0% financing on the purchase of a new car or not. It can also help you determine if it is worth taking a cash rebate on your credit card or not. The term present value is often used to measure the value of investments and bonds in the future. It can be used to estimate the amount of interest a person will earn over time, or how much a bond will pay out in the future. Many financial calculators and spreadsheet programs include present value functions that you can use to calculate this value. It is also possible to use a free calculator on the internet or a financial calculator app for smartphones and computers. Future value. One of the most important concepts to understand when it comes to financial planning is the time value of money. The time value of money is the idea that a dollar today is worth more than a dollar tomorrow if it's invested or earned a steady rate of interest. This is a good reason to start saving now and to keep track of your savings goals so that you can meet them. If you're not sure whether your current savings will be enough to reach your goals, you can use the time value of money to determine how much more you need to save each month. The time value of money is also useful for comparing different investments or cash flows. For example, you may want to compare the future value of two investments that require a specific amount of money for the next 3 years, and each one is expected to return 10% in year 1, 10% in year 2, and 35% in year 3. A number of factors can affect an investment's FV, including inflation, interest rates, and economic events. These factors are reflected in the formulas used to calculate future value. There are many different formulas for calculating the future value of money, but they all rely on the same basic principles. These principles include discount or growth rates, compounding periods, initial investments, and initial and accumulated interest. While the formulas can be complicated, they are generally easy to understand and work well for a wide range of situations. However, they may not be very accurate in some cases because they can't account for certain factors that are likely to impact a particular asset. While it's important to understand the time value of money, it is equally as important to remember that it isn't always a reliable predictor of an asset's future worth. This is because the value of money can fluctuate dramatically over time. Compounding. Compound interest is a time value of money concept that makes investments worth more over the long run. If you put $1,000 into a savings account that pays 5% interest, it will grow to $1,020 by the end of a year. It can be an extremely powerful tool when used correctly. There are a few things you need to know about compound interest to understand its power. The first is that it works best when it occurs on a consistent basis over a long period of time. This is important for anyone who wants to grow their wealth, and especially if you want to retire with financial security. If you invest $300 a month and earn an average of 7% per year over 45 years, you can wind up with nearly $1 million by the time you retire. However, compounding can be a detriment to your savings and retirement if you wait too long to start investing. This means that it's critical to understand how compound interest works and what you can do to minimize its effects. The key is to start saving early and keep contributing regularly. Getting started early can be difficult, but it's crucial to building your wealth over a long period of time. Once you start saving, compounding can help your savings and investments grow faster than you could imagine. This can help you build a substantial amount of wealth over a short period of time, and it can also help you make the most of tax-advantaged accounts, 401(k)s and Roth IRAs. It's essential to recognize the power of compounding and how it can help you save and invest more effectively. Fortunately, compounding is easy to calculate and can be a very helpful tool when used correctly. The main factors in calculating compound interest are the rate of interest, the number of compounding periods, and the frequency at which the compounding occurs. These can all be found in published tables of factors, which are often easier to use than calculating them from one of the formulas. Using these factors, you can easily solve a wide range of time value of money problems, including discounting, intra-year compounding, annuities due in perpetuities. You can also use these factors to calculate the present value and future value of your money. Inflation. Inflation, or the rate at which goods and services become more expensive, is a common phenomenon in economic cycles. It may be a cause for concern for some, but the impact is relatively short-lived and typically temporary. In most cases, the rate of inflation is measured by comparing the price of a particular basket of goods and services to the same basket that was purchased at a similar time in the past. The Bureau of Labor Statistics, BLS, and other statistical agencies use a method called the Consumer Price Index, or CPI, to measure the rate of inflation. Generally, the CPI is based on a diversified set of products and services that are most commonly consumed by Americans. It then calculates the rate of inflation by dividing the average value of that basket over a period of time, such as month to month or year to year, by the same basket's value from a previous period. There are many factors that can contribute to inflation, including increases in the money supply, government spending, and increased competition for certain products. Inflation is also a result of cyclical movements in the economy, such as higher prices for oil or a spike in interest rates. It can also be caused by economic events that disrupt supply chains and reduce the amount of goods available, or natural disasters, which affect production costs. These events can increase the rate of inflation by pushing up prices on the stock that remains, even if demand for specific goods has not changed. One of the most important aspects to understand about inflation is that it can chip away at investment returns. Most investors aim to increase their long-term purchasing power, but inflation can make this goal difficult to meet by reducing the amount of real savings and investment returns. Some ways to counter inflation include diversifying your portfolio, avoiding investments that are sensitive to rising prices, and focusing on real assets such as gold or real estate that retain their value. Moreover, some types of bonds, such as those issued by the Treasury Department, are protected against inflation and offer a return that is less sensitive to inflation, allowing you to benefit from a lower interest rate in the short term while still enjoying a positive return in the long run.